Before Britain ruled oceans with ships, it discovered something far more profitable than maritime dominance. It realized control didn't require owning seas, commanding fleets, or patrolling distant coastlines aggressively. Real power came from pricing the movement across oceans, turning global trade routes into revenue streams. Thus emerged the shipping shadow tax, a system invisible, elegant, and devastatingly effective for empire building. The world believed trade depended on geography, winds, currents, and the unpredictable temperament of nature. But Britain learned trade depended on paperwork, contracts, risk calculations, and insurance rates far more. If you could price the risks, delays, storms, and losses, you controlled maritime economics absolutely. You didn't need ships to rule oceans. You needed mathematics woven into every voyage. London's merchants met in smoky rooms, realizing they could profit without touching a single ship hull. They calculated probabilities of shipwrecks, piracy, supply shortages, and seasonal dangers using meticulous ledgers. These calculations became premiums, fees, guarantees, and clauses embedded into contracts worldwide. Merchants across continents accepted these terms, unknowingly submitting to Britain's new maritime authority silently. Insurance became the empire's first invisible anchor, holding global shipping under London's unchallenged influence. Lloyd's Coffee House transformed into a financial fortress where probabilities dictated global maritime behavior. Every voyage required Lloyd's approval, turning ocean movement into a predictable revenue-generating cycle. Britain taxed uncertainty, monetizing fear, ambition, and desperation with unprecedented sophistication. Ship owners realized without British insurance, their vessels faced ruinous risks unacceptable to investors everywhere. No bank-financed voyages lacking Lloyd's certificates, and no port trusted ships sailing uninsured entirely. Britain never forced compliance. Necessity simply drove the world into its financial embrace. Thus the shipping shadow tax began, invisible, enforceable, and integrated into every maritime journey. As empires expanded overseas, the volume of global trade multiplied, increasing Britain's influence exponentially. More ships meant more insurance, more fees, more contracts, and more profits for London's financial elite. Britain became the silent recipient of wealth generated by foreign vessels crossing foreign waters routinely. The empire grew richer not through conquest, but through quietly pricing movement itself. Foreign merchants grumbled about dependence on British terms, yet alternatives lacked credibility or global trust. Other nations attempted building rival insurance markets, but none matched London's accuracy or reputation. The world accepted British pricing not because of favour, but because of survival. A voyage without British coverage felt like gambling with destiny against insurmountable odds. London's brokers studied shipping patterns with scientific obsession, transforming observation into predictive economic power. They knew which ports suffered corruption, which seas harboured pirates, and which routes faced dangerous storms. This intelligence fed into premiums, giving London unparalleled insight into global maritime vulnerability. Britain monetized information, turning knowledge into a currency stronger than gold or gunpowder. Ports across Asia, Africa, and the Americas adjusted schedules, fees, and procedures based on British assessments. A negative risk report from London could cripple a port's economy for an entire season. A positive assessment strengthened prosperity, attracting fleets eager for safe harbours under predictable terms. Thus, Britain manipulated port growth worldwide, shaping maritime geography through financial mapping, not military force. Merchants began timing voyages around London's advisories, treating British recommendations as navigational gospel. No admiral commanded such obedience. No government exercised such global behavioral influence. The shipping shadow tax embedded itself into trade culture, dictating movement like an invisible tide. Even the ocean seemed to follow London's rhythm. Though the empire never claimed ownership, shipping companies found profits hinged on aligning operations with London's assessments and risk calculations entirely. Routes, cargo types, staffing decisions, and schedule planning all responded to British-derived cost structures. This meant London didn't just price movement. It shaped the very architecture of global trade. Decisions in remote ports originated in quiet rooms inside Britain's financial district unknowingly. The empire expanded influence through reinsurance, allowing London to earn from risks covered by foreign companies. Even when Europeans insured their own voyages, British firms insured those insurers for added security. Thus, Britain profited twice, once directly and once indirectly through reinsurance chains. No nation equaled this sophistication, allowing Britain's financial ecosystem to dominate global shipping entirely. Soon, Britain didn't merely price voyages. It priced cargoes transported across every oceanic corridor. Coffee, silk, coal, grain, silver, wheat, cotton, everything bore embedded costs determined by London. A farmer in South America unknowingly paid part of his income into Britain's maritime system. A trader in China unknowingly contributed to British profit simply by exporting goods overseas. Ports sought British-trained inspectors to gain credibility that increased trade volume and dockside prosperity. These inspectors assessed reliability, fraud risk, infrastructure safety, and cargo accuracy using British criteria. Approval created trust, elevating ports into essential nodes of global movement synchronized with London. Thus, Britain shaped which cities thrived and which collapsed, all through silent scoring systems. Nations ambitious about expanding maritime influence discovered they needed Britain's backing before succeeding internationally. Shipyards required British underwriters, crews required British contracts. Exporters required British compliance documentation. Britain controlled standards, and standards controlled who could join the global maritime economy effectively. Thus the ocean became British territory in practice, though Britain never claimed such ownership publicly. When storms destroyed fleets or wars disrupted shipping lanes, Britain profited through rising premiums immediately. Crisis wasn't detrimental. It amplified the empire's revenue, tightening dependence on its financial services. Foreign governments rebuilt fleets using loans structured in London, increasing reliance for decades afterward. Thus, disaster served Britain as effectively as stability, reinforcing the invincibility of the shipping shadow tax. Colonial trade surged, and Britain earned from every movement regardless of origin, route, or national flag. The empire no longer needed ships to dominate seas. Paperwork ensured victory without naval engagement. Insurance policies, clauses, and conditions became stronger than cannons, reshaping global maritime power silently. Britain defeated rivals not through fleets, but through forms stamped with mathematical authority. Shipping companies discovered late payments or missing documentation triggered penalties enforced through British legal systems. These systems, respected globally, ensured compliance across continents without military intervention required. Contracts became tools of control, granting Britain legal dominion disguised as commercial normality. The world joined willingly. Unaware British influence tightened invisibly with each signature. Merchants avoided ports lacking British-approved insurance because cargo risk multiplied without financial backing. This created economic deserts, places where ships refused to dock, destroying local commerce instantly. Britain didn't need blockades. Financial exclusion achieved identical results with far less hostility. Economies rose and fell according to Britain's silent maritime assessments, dominating international movements subconsciously. In distant harbours, sailors spoke of London like a supernatural force, deciding their fate hourly. They feared storms and pirates, but feared insurance cancellation far more because survival depended financially. Britain engineered that fear, creating a world where movement itself demanded British blessing unconditionally. Without that blessing, ships remained anchored, powerless against the Empire's invisible maritime chokehold. Financial historians later recognized the shipping shadow tax as one of Britain's most brilliant inventions ever. It replaced conquest with calculation, replaced naval battles with paperwork, and replaced occupation with necessity. No empire ever taxed the world so efficiently without enforcing obedience through overt domination. Britain achieved global maritime governance without ruling a single wave legally or geographically. And as steamships replaced sails and engines replaced wind, Britain's influence only grew stronger exponentially. Faster ships required more insurance. Heavier cargo demanded better risk calculation. Globalized trade demanded stability. All roads led back to London, the capital of risk management, maritime mathematics, and commercial certainty. Britain didn't chase the world. The world came willingly, seeking the Empire's financial guidance unconditionally. As steamships multiplied across oceans, Britain realized speed increased risk and risk increased profitability simultaneously. The faster the world tried to trade, the more it depended on London's precise maritime calculations. Insurance premiums rose with engine complexity, route density, and cargo volume expanding across global shipping networks. Thus, modernization didn't weaken the shipping shadow tax. It multiplied British influence through mathematics alone. Telegraph lines accelerated communication, allowing London to adjust premiums instantly as storms or conflicts emerged. This real-time pricing transformed maritime economics, giving Britain a dynamic tool controlling global shipping behavior. Captains followed Lloyd's warnings like commandments, altering courses even when governments issued contradictory instructions. Britain didn't govern ships directly. It governed their fear of financial repercussions hidden within risk algorithms. As railways connected inland economies to coastal ports, maritime dependency increased exponentially across continents. Every ton of produce, minerals, machinery, and textiles eventually touched a ship subject to British assessment. Thus, British oversight expanded inland, shaping agriculture, mining, manufacturing, and urban planning indirectly. Anything moving toward a port contributed to a system Britain engineered to profit from movement itself. Banks issued loans for fleet expansion contingent entirely upon London's evaluation of shipping industry stability. When London approved, money flowed freely. When London hesitated, entire shipbuilding districts collapsed overnight. This control wasn't illegal or military. It was psychological dominance through economic expectation and institutional trust. Ship owners learned their future depended less on government policy and more on British financial sentiment. As colonial wealth surged, Britain refined its maritime taxation model to extract revenue unnoticed by nations worldwide. Every cargo invoice included invisible layers of British pricing, hidden within insurance, reinsurance, brokerage fees. Governments attempting independence from Britain still paid these fees indirectly through their merchants unknowingly. British influence persisted because the world couldn't function without the risk frameworks London maintained continuously. Foreign intelligence services soon realized British maritime data offered unmatched insight into global economic behavior. London knew which ports thrived, which industries slowed, and which regions faced instability before anyone else. This information allowed Britain to forecast geopolitical shifts purely from shipping patterns observed meticulously. The Empire didn't just price voyages, it interpreted them as signals of international power changes. Shipping companies attempted forming alliances to negotiate lower British premiums, but found no viable alternative counterpart. Local insurance markets lacked global trust, historical data, and the financial reserves needed for major claims. Thus, London remained indispensable, functioning as the world's maritime central bank determining risk and resilience. Every attempted rebellion against British influence eventually collapsed beneath the reliability of London's actuarial strength. Governments finally understood that controlling ports, or fleets meant nothing without controlling the financial contracts governing them. Britain mastered these contracts, embedding clauses that ensured disputes defaulted to London's legal systems consistently. Whenever conflict arose, courts in Britain interpreted maritime law with global authority unmatched anywhere else. Thus, British control endured through precedent, reputation, and contractual dominance, not through territorial ownership. As global empires fought wars, shipping lanes became battlegrounds for economies facing unprecedented instability and risk. Insurance premiums skyrocketed, generating extraordinary revenue for British institutions unaffected by frontline destruction. War punished participants, but rewarded Britain with increased dependence on its maritime financial infrastructure. The empire prospered from chaos without firing a shot, using risk as its most powerful strategic weapon. In peacetime, Britain controlled expansion by determining which ports received favorable premium ratings encouraging growth. A port blessed with low premiums flourished. One burdened with high premiums decayed almost immediately. Thus Britain sculpted global trade geography, choosing winners and losers through mathematical judgment alone. Mapping the world became an exercise in pricing risk rather than drawing borders or conquering lands. Foreign leaders complained privately that Britain dictated economic destiny without appearing dictatorial or aggressive. They saw British influence in every ship manifest, insurance clause, contract dispute, and freight calculation everywhere. It was empire without empire. Domination disguised as helpful financial structure stabilizing global commerce seamlessly. Britain earned gratitude instead of resentment, even while extracting wealth from every maritime transaction. Shipping technology advanced rapidly, yet each advancement created vulnerabilities only Britain could analyze effectively. Bigger ships demanded stronger insurance. Refrigerated cargo required specialist evaluation. Fuel systems required oversight. Thus, innovation reinforced dependence, each improvement forcing closer collaboration with British maritime institutions. Modernity didn't free the world. It bound it tightly to London's ever-expanding analytical empire. Economists later described Britain's maritime system as the world's first global algorithm controlling economic movement. It processed risk probabilities, environmental data, cargo composition, seasonal patterns, and political instability precisely. Output became premiums, shaping the world's navigation decisions and international supply chain behavior entirely. Human intuition disappeared. Mathematical authority governed oceans under British supervision unobstructed. When the empire declined politically, maritime influence remained untouched because infrastructure outlived territorial power. Former colonies continued using British risk assessments, contracts, and underwriting standards without considering alternatives. The world realized replacing British frameworks required global coordination impossible amid competing national interests. Thus Britain's legacy persisted effortlessly, turning historical systems into permanent pillars of international trade. Modern shipping containers multiplied efficiency, yet each movement still required insurance grounded in British methodology. Even digital tracking, satellite forecasting, and automated logistics rely on actuarial principles engineered in London. Technology changed tools, but preserved the architecture Britain constructed through centuries of maritime calculation. The shipping shadow tax adapted smoothly, continuing to extract value invisibly from every container crossing oceans. Today's global shipping giants operate fleets unimaginable in size, but none escape British influence completely. Their headquarters may sit in Asia, Europe, or America, yet their risk models follow British formulations. Their biggest loans require British-style metrics, and their largest claims settle through London-based arbitration. Thus, Britain governs shipping not physically, but through systems controlling how movement is priced universally. Even internet commerce, reliant on container ships carrying vast cargo volumes, pays Britain's invisible maritime surcharge. Every product crossing oceans includes embedded insurance structured around British risk calculations unchallenged. Modern consumers unknowingly fund centuries-old systems designed to enrich institutions built during imperial ascendancy. Thus, the digital age continues feeding the empire's ghost, concealed beneath spreadsheets and logistics algorithms. Scholars now argue Britain achieved one of history's most extraordinary economic victories through this system alone. It created an empire of fees, premiums, clauses, and calculations shaping global behavior without military expenditure. The ocean became a global marketplace where Britain charged admission quietly, efficiently, and permanently. Even nations resisting British influence economically remain bound to maritime pricing structures devised in London. When shipping disruptions occur today, global markets react violently because maritime economics form civilization's backbone. Delays cause shortages, shortages cause inflation. Inflation shapes elections and destabilizes governments internationally. And behind this chain, an actuarial logic crafted centuries ago by Britain's maritime architects. Their system remains unbroken, continuing to influence global stability through invisible financial mechanisms. Britain once ruled waves through wooden ships, captains, cannons, and imperial ambition stretching across distant horizons. But the empire learned a deeper truth: money travels faster than ships, and risk governs all movement. Thus the shipping shadow tax became Britain's greatest maritime weapon, conquering oceans without touching their waters. It remains active today, an invisible tide pulling global commerce into the gravitational center of London. If this story changed how you see power hidden beneath oceans, remember, empires thrive longest when their systems outlive their flags. Subscribe for more untold histories shaping the modern financial world, because the next wave of influence may already be silently moving.